Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me typically would be the man himself, the governor, smartest guy in the room, Mr. Michael Becker, but he is on another due diligence assignment, so we wish him and the group over at SPI a lot of luck. They're doing wonderful in buying apartment buildings. So sitting in the podcast today, the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
James, what's going on in the Old Capital world these days?
We just wrapped up our Hoops for Homelessness 3-on-3 basketball tournament. We saw a lot of squinched faces and a lot of sore people after a good 4 hours of 3-on-3 basketball with everybody.
I've never seen people play as hard as these guys did as adults. I mean, I've seen the 7-8-year-olds play, but these guys were 48-year-olds playing.
Well, when you have to compete versus people that you know in the industry, you play just a little bit harder than you do at your kids' basketball game. So it was entertaining. And we raised $14,500 for City House, which is a great nonprofit here in Dallas. And so that was our sort of March event. And then our next big event is going to be October 24th and 25th, which will be our annual conference here in Dallas. And so that's our big event. Last year we had probably 650, 700 people over at AT&T Stadium for that event. And so go on to oldcapitalpodcast.com and you can get more details as we release them.
I don't want us to forget we're having a conference with Greg Willett up in Northern California, up in San Mateo on May the 9th. And so if you have a chance, go to the Old Capital Podcast and register for that. Greg Willett, he is the godfather of multifamily economists. He's the guy that really actually knows what's going on. You want to, if you're up in Northern California, you're an investor in apartments or want to be an investor in apartments, he's the guy that you want to listen to and get his take about what's going on. So go to the oldcapitalpodcast.com, register for Greg Willett on May the 9th. So we look forward to having you come on and do a little networking too, besides getting some great information. So in the podcast today, we have two of our friends that I think I met you 5-6 years ago, a long time ago. So Bill Mara and Pat Poling, and they're going to tell a little bit of their story. These guys were institutional real estate guys, and then now they've gone into individual real estate stuff. Same type of stuff, but a little bit different, and they're going to talk a little bit about what they do in the multifamily industry, which I think is pretty interesting. These guys have been friends and partners for over 30 years. They've done a number of business transactions together, and I think if you can be successful in a partnership for this long a period of time, you must be doing something right. So they certainly are blessed of being together. You know, marriages don't last this long, so you guys have done a great job by keeping it together. So I'm going to turn over to the Grand Inquisitor, James Eng. Let's talk to Bill and Pat.
Sure. Well, welcome Bill and Pat to the podcast. If you guys can maybe give us a brief introduction on sort of how you guys got started in multifamily.
You bet, James. Thanks for having us both here today. Bill and I have worked together for a long time. Prior to founding Mara Poling and our focus on multifamily, we had an asset management firm that focused in the industrial space with institutional clients. And that was great. We were really successful. We made a lot of money for somebody. I don't really know who it was because we never got to meet any of those folks, right?
Sure.
Our clients were CEOs and CFOs.
How much money did you actually put to work?
So we raised about $4 billion over the course of a dozen years. Our growth rate was essentially about $1 billion in equity growth annually.
Wow.
On the portfolio. Some of that from new development, a lot of it from lease up of the existing assets. Like I said, that was a lot of fun, and we developed some really wonderful processes there. Many of our clients were publicly traded firms. We had very heavy regulatory requirements that we had to deal with. And as we wrapped all that up, it was, like I said, a lot of fun, but something was missing. And the piece that was missing was a personal relationship with the individuals that ultimately we made that money for. And as we started thinking about what to do next, that was a big part of the driver for multifamily and for Mara Poling was how could we build relationships with individuals where we could take our Wall Street expertise and bring it down to a Main Street investor, to the extent that you can call a high net worth individual a Main Street investor. But how could we really help those folks?
So, Bill, what did you see in multifamily that you liked, sort of transitioning from the industrial sort of commercial side, moving into multifamily? Was there anything that you saw that you really liked about multifamily?
Yeah, several things. To hit on one of the things that Pat had mentioned was the ability to work with individuals, impacting their lives as opposed to the bottom line of corporate America. We were able to hear the stories of investors, how they raised their money, how they earned it, most of them, and their plans for what these investments are going to do for their family, put their kids through college, be able to pass it on to their kids and grandkids, those types of things. That was something that was very important to both of us to be able to do that and see the impact that we were having on the lives of our investors and the relationships. So that was one opportunity. The other is in multifamily in particular was we both had investments on our own in this asset class, and we really liked the opportunities that we think that it affords. We think there's a fairly long runway, 10 to 15 years. There's a disparity between the need for Class B workforce housing. They're not building that. Anything that's new today, because of construction costs, are Class A with all the extra amenities, not necessarily designed for workforce housing. We liked that asset class, that piece, being in the Class B world, trying to develop a safe place for families to raise their kids and have a economic place to live.
Yeah, so we've had you guys go through, I guess, 3 deals here in the last couple of years. So why don't we just start with maybe your first deal out there in Cleburne, and maybe give us a little bit of, a lot of people get stuck at zero. How much sort of pre-work went into before even buying that first deal? Do you remember that far back on what you guys had to do to sort of get together, make the plan, and then actually start making offers on deals and getting comfortable and raising the equity? Maybe take us back to 2016.
So keep that in your mind. That's a great question, but I want to go even farther back. What makes a successful marriage between two guys that have been in business as partners for 30 years? I mean, marriages don't usually last this long, but you guys have been business partners for 30 years. You guys have done lots of different things. What makes it successful? What is your words of wisdom to some guys that even before they do their first deal, that they're out looking for partners? What do you tell them?
You mentioned the word blessed before,
yeah.
And I really am blessed to have Bill as a partner. It's not about a business relationship at all. And you know what? We're actually not like weekend fishing buddy friends.
Yeah.
We don't spend a lot of time together outside of our business relationship. But first and foremost, we're partners in that sense. There's also a great complement in terms of our skills and our personalities. If you didn't ask Bill a question, you'd hear me nonstop for this entire session, because that's just my personality. And so I take on those responsibilities within the organization that require a little more of an outward facing responsibility. Bill knows the technology and the nitty gritty, how to execute and get work done, which I'm not bad at. It's just Bill's so much better at that than I. And our entire career has really been built around taking problems that we found and opportunities and then divvying them up in that way and supporting each other, but also letting each other just run with those pieces.
What would be one thing that you could say positive about your partner?
Boy, I don't know that I can narrow it down to just one. Not only is Bill a great listener, he knows how to provide feedback in a truly constructive way. Mm-hmm. I get a head of steam going in one direction, and that's good for us to have that kind of drive and energy. But that needs to be redirected on occasion to the right target. Yep. And Bill's great at doing that in a way that doesn't damage our partnership.
Bill, 1 or 2 things for Pat. What makes this partnership so strong?
So Pat, as he pointed out, he's kind of the vision guy, mm-hmm. and sees, okay, here's what we want to do. Here's where we want to go. Then I'll bring a deal and Pat's first role is to shoot as many holes in that deal that he can. And then he gets it to a point of, okay, I think we can do this. And then I give him feedback on, okay, well, here's why that won't work. So we're very good at bouncing that back and forth. And that's primarily comes from Pat's leadership of, our role is to find as many holes in every opportunity that we can. And if it can make it through that scrutiny, then that's a deal we can probably pursue.
Yeah, because you guys are looking for, let's say, long-term moderate risk transactions in the multifamily space.
Correct.
So, James, I'm going to let you go back because I think I understand a little bit more about where this glue comes from in the partnership. Okay, go ahead.
Yeah, I think Pat's bringing a lot of the sort of high-level vision and communication aspects, but then also Bill's bringing sort of that deal analysis, the detail that comes around that. And I think every successful partnership needs people who are going to do different roles. And so that's perfect. So maybe talk to us about that first deal and sort of how you guys looked at that deal and got comfortable with that deal.
So the deal in Northridge, in Cleburne, so it was the first deal for our fund, but we had already been doing multifamily acquisitions here in DFW for 3 years prior to that. We had closed on $36 million in assets. And more importantly, we had established relationships with brokers and a reputation of being able to do what we say we are going to do.
Right.
We had closed 100% of the deals we had gotten into contract on, and that's valuable and important.
And again, why DFW? Why did you guys take that macro all the way down to the micro from the United States down to DFW?
Well, so great question, because we looked at all the MSAs, the metropolitan statistical areas in the U.S., and we had a criteria of 27 factors, I think, and, job growth, income growth, domestic and international migration. There's like I said, there's 27 items on that list. And when we looked at all the markets in the U.S., compared it against that list, there was 20 some markets in the U.S. that met every one of our criteria. Half of those were in Texas. And we figured, okay, we got to be somewhere in Texas. And the Metroplex was the largest. At that time, there was 7 million people in the DFW Metroplex. We figured, okay, there's got to be plenty of opportunity there for us to focus on. So that was our target, was DFW.
So you purchased a number of properties in the Dallas-Fort Worth market. Now, the transaction we're going to talk about was in Cleburne, which is kind of would you say a secondary or tertiary market, a little bit outside. How far from Fort Worth is Cleburne away?
So Cleburne, it's a great market. It's a 20-minute drive from our asset to downtown Fort Worth. And it used to be a little bit longer than that, but they just opened the Chisholm Trail Parkway, which allows people that access into, the larger market. So it opens it up for...
And you knew that before you bought the asset.
Correct. That's one of the things we look for is, okay, we always look for when we're looking at deals, what's our end game? What's our exit strategy? And we could see that Cleburne was developing. There was already some new development on the north side, and there's development starting to fill in between Cleburne and Fort Worth. So we thought that would be a great opportunity. Cap rates were not quite as tight out there. The last few years, cap rates in the Metroplex have tightened up quite a bit. So we started looking to secondary markets.
Was the property listed for sale, or were you able to take it off market? Tell us a little bit. James is going there, but how did you find the transaction?
It was a fully marketed deal, email blast out to everyone. And like I mentioned earlier, our reputation, the acquisitions we had made previously, we were able to work with the broker, and we submitted a preemptive offer and was able to work with the seller to accept our offer and have him take the property off the market. And we worked directly with him.
Yeah, so on this deal was actually one of the sellers that we knew pretty well. So we did the first loan on this deal. So it was an assumption of an existing Fannie Mae loan. And then you guys were coming in and adding a supplemental loan on this deal. So on this particular transaction, it's been a couple of years. What have you guys done on the property, and sort of how have you improved rents, other income, any of those opportunities to discuss?
We have a basic package that we target for all of our acquisitions. We did new plank flooring, we two-tone paint, reface the cabinets, paint the cabinets, new light fixtures, LED fixtures, plumbing, door hardware. Basically redid the whole interior. The exterior, the prior owner had done a lot of improvements, new roofing. They had re-sided a lot of the property. We finished re-siding it, all new hardy plank. We resurfaced the parking lot. So we gave the property a good pop,
right,
and improvement. So brokers now, when they look at the property, they really like it. We think it's one of the best properties in Cleburne for the value.
So now that property is on the market.
It is.
So what is the story for the next buyer? If they're potentially listening to this podcast, what's the story for the next buyer? What is there left to do, and potential upside in rents for them?
So we've already achieved our rent target in terms of rent growth. We actually have only improved about 40% of the units.
30% actually.
30%. I stand corrected. So an awful lot of that came from our original analysis was, there's some opportunity here from an improvement standpoint in terms of the value add side of it. There was also just a pretty significant delta to market. Okay. And there were really only 2 solid Class B assets in town. So there was definitely room for a third asset. This property also has a fairly unique component. About half of the units are all bills paid. And most investors are going to say, oh, well, that's a great chance to buy it and get rid of the all bills paid and go to a direct bill method, sure, right? All bills paid has been wonderful for us in that market. There's a definite need for individuals that want a quality place to live, nice finishes, nice interiors, and yet the simplicity of being able to write one check and take care of themselves. So when we took the property over, we began moving rents even before we started the improvement program. The all bills paid side of the property hit its rent targets for the improvements before we even put a dollar into making any improvements on that side, just from improvements in the management of it. So there's still some opportunity there. As I said, there's units that need to be improved. The office is actually in an existing unit. We've got plans. We simply hadn't gotten around to building it yet, but there's plans now to build an office. So there's a unit that can be recovered from that standpoint. And we're actually still not at market. We're still below the other 2 assets when you look at rent comps. So a really good, solid upside for whoever wants to come along and take it to that next level.
Let's talk a little bit about the property itself. Again, for people who have never seen the property, again, what year was the property built?
It was built in 67.
67, flat or pitched roofs?
Flat mansard roofs.
Flat mansard roofs. And do you remember what the rents were when you guys bought the property, and what have the rents gone to on the units that have been updated?
Average rent at the asset was in the mid 700s. I think it was like 750 or 760, something like that. Our average right now is north of 9.
Wow.
Improved units are getting anywhere from 950 to 1,050.
Now let's go back to the all bills paid, because people talk about that all the time. In some markets that works, in some markets that doesn't work. I mean, this is a Cleburne market. This is kind of a secondary, tertiary market. Again, there's not a lot of product like that out there. The products out there are Class A properties, and this is a Class C property, maybe a C plus, B minus property, I would imagine. And you can get additional income if you do offer the convenience of having person pay one check to pay all of his utilities to the landlord. Now, the landlord's on the hook to make sure that utilities get paid. But in a market like this, especially in Texas, where we have the ability to change energy contracts out, it's not a take it or leave it type of a deal. You can actually find different ways of pricing kilowatt hours, so you can try to get your lowest cost provider out there. The tenant base wants it, it demands it. There's a great margin to be made on that type of stuff to offer the convenience, and I think that works in this market.
It does, and there's an expense saving side of that equation too. So Bill mentioned in our value add improvement list, and this is something we've actually expedited, so it's been done across more of the units, was lighting and plumbing. So in those all build paid units, LED light packages, water conserving, plumbing fixtures, because we're paying the utility bill, right? Mm-hmm. So if we can get those investments in there, we get a savings on the expense side at the same time that we're able to help tenants realize that value in, I really do like having this, I pay one check and it's taken care of. So does that mean that every property with all bills paid should be run that way? I don't know. In this particular market, it made sense. It's also one of those things, and this is an example of, we always have a good plan going in, but we also know that it's not going to work, right? Nothing's ever going to work the way the plan is.
Yeah.
So, part of the strategy was when we get in, well, let's see what we can do with rents in those units. If being a little more aggressive on rents would have been met with, a thud, then we might have actually looked at moving away from an all bills paid structure, but it didn't, right? Mm-hmm. We got positive feedback on it, and the more positive feedback we got, the more we moved. Because ultimately that's how rents move. And our property teams will often ask us that, well, how much should we raise the rents by? And I said, we'll raise them enough that we keep tenants here, but not too much that they leave. Because that's effectively the way the market works, right?
Mm-hmm.
And
it's an art.
The way it is an art, but it's ultimately the only way you're going to know what the real market rent is to move in the marketplace until you find that mean point. Not only are rents strong there today, we don't have any product. The next units coming available, I don't think are available for another 60 days or so. And the flash report I saw this week, we had 2 notices to vacate and they both leased within a few days. So clearly there's still room there in that particular market for that kind of an asset, which age-wise, Paul, you're right, is a C+ kind of asset. When we think about asset grade and age, we look a little more at infrastructure than we do just when the asset was built. So chillers, boilers, old technology, flat roofs, those we really want to stay away from. These units, individual hot water heaters, HVAC units, modern technology roofs. So it looks exactly like a property that would have been built in 1980. It just happens to have a flat roof and 18 more years on it than a 1980 would.
Is there anything that, if I took you back to 2017 and said, all right, what would you have done differently knowing everything that you know now in the last 2 years? Is there anything you would have done differently sort of when you walked in the door when you bought that deal?
We'd have moved faster. So every deal we do a debrief. We just last week sat in the office with the team and went through the debrief on the San Antonio acquisition we just finished. And one of the items we identified on that was, even though we have improved with every single acquisition, we still aren't as fast out of the gate as we'd like to be in terms of implementing.
Take over. Okay. So I guess moving on to, you guys went a little bit further southwest down to Waco on your second deal. Is it still called Colonial Arms? It was called Colonial Arms.
It was called Colonial Arms.
Yeah.
We've rebranded it to the Edmond.
Okay. So that's 123 units. Tell us about that deal and sort of the story behind that one in terms of acquisition and financing.
So that was a fully marketed deal as well. We went to call for offers date on that, and we're just able to secure it, again, based on reputation. I don't believe we were actually the low bidder.
Or highest bidder.
Or the highest bidder.
Sure, yeah.
I wish it went to the lowest bidder. If we could do that, I'd be really happy.
Yeah. So just fully marketed. We had a strategy going in of doing the unit upgrades. We wanted to be a little more aggressive than we were at Northridge. When we took over the property, we found out that there were more substandard tenants than we were led to believe.
Okay.
And doing upgrades had a negative impact. It was also known as a second chance property.
Okay.
And so,
James, what does that mean?
So a lot of times we run, criminal credit and make sure that nobody has any felonies or, they haven't skipped out on their last rent payment somewhere else. And some owners are more lenient. Some management companies are more lenient on that. piece of it. And so they will just fill a place up regardless of credit, regardless of criminal, regardless of anything. Or they don't even run it. They probably don't even run it. They just, you can, I guess, pay the first month's rent, you're in.
Yeah. And we were very fortunate here that there weren't criminal felony issues, but this was a 2.5 times rent property, which we just have an issue with 2.5 times rent, not just from a investor standpoint.
What does that mean, 2.5 times rent?
So a tenant needs to have income 2.5 times what the rent is. So if the rent is $800 a month, then they have to have, what's the math on that? $2,000 a month of income. So there's some risk at 2.5 as opposed to 3. At 3, somebody's going to have $2,400 of income. We also think not just there's a risk, but the notion of having someone live in a place where they have to take 40% of what they make and instantly give it away. And that's a gross number, their income. So after taxes and other things, we just think that's a real challenge. And that's not a market we're looking to participate in. But, one of the ways you can make a property look really good before closing is you just don't kick anybody out, right? And the numbers run up. And so it was a bigger challenge. We knew it was going to be a challenge going in. It simply turned out to be a larger challenge. And our little bit of sprucing up on the outside turned into a full-on rebranding of the asset.
Okay. And then you guys have owned this asset for a year, almost a year and a half. How much did occupancy sort of dip once you took it over, and then how's it trended back up now?
We underwrote at 90%. We dipped down into the 80s. We didn't get below 80, but we got in the lower 80s. And at a certain point, that became intentional. It just became, all right, you know what? We just need to cycle through any tenant that's not a good fit, and let's help them transition on to what's going to be a good spot. That was all happening while the rebranding was occurring. We're well north of 90 right now, even though our underwrite's right at 90. Rents are exactly where we expected them to be. Income to rent ratio is around 3.5 on average.
Wow.
So it has become the asset we expected it to be. And that's one of the reasons we underwrite the way we do. We know something's going to go sideways. We just don't know, is it going to be rents, occupancy? Are we going to need to put more capital in than we thought? Is some expense going to be higher? And so we'll leave room in every one of those line items, knowing that something's going to be an issue.
Is there anything that you learned from your first acquisition and operationally and brought it to the second one?
Well, yes. Part of it just being the kind of asset we selected. So this is a larger property, 123, allows us to have a greater staff presence, gives us some more flexibility from that standpoint. We also, as I said earlier, we were much faster out of the gate in terms of making the improvements we needed to, and, dealing with some of the deferred maintenance and other items that were out there. Still wasn't perfect, and we learned from that, which we applied to the next one. Which, if we ever buy an asset and have a debrief and say, "Well, gosh, that one was perfect. We don't need to change a thing," I'll call you guys.
No, so I'll touch on financing on this one for a little bit. So this one, you also came in and did a Fannie Mae loan, got 3 years interest only, about 75% loan to cost. How did you guys decide to do sort of a Fannie Mae loan on the first one and now the second one?
The first one, it was an assumption.
Sure. Yep.
And so that dictated what we were going to do.
Okay. But the second one, so on Colonial Arms, that you decided to go with a new Fannie Mae loan. How did you guys decide to do that and sort of?
Well, one of the things on that loan in particular, we did the green program, which helped us, gave us money for upgrading the water
conservation. Sure.
Water conservation. Okay. So that was one of the factors.
Which we were doing anyway.
Right.
Yeah. Right. So it's kind of free money from that standpoint. You're going to change out the fixtures. You might as well get credit for it.
Yeah. Get a better interest rate in the meantime. Yeah.
And we can claim that we're helping improve the environment.
Right. Yeah.
Let's claim we are.
So that was one of the factors. Right. And then Fannie loans they're good loans. They're the process, as we've just learned, the process in a Fannie loan was easier to deal with. I don't know, hurdles to get over are harder or not. I don't know that. And it was just a good value for us. It helped us meet our objectives.
So one of the things that, and again, this may be maybe we're a little different. We might not think like everybody else does. We love a really rigorous, challenging lender process. Okay. Lenders are our friends. We don't look at that.
We don't hear that
enough. Well,
they're the largest investors.
God bless you, my son.
Well, they're going to write the biggest check. And if they've got an issue with the project, we should all have issues with the project, and investors should have issues. It's like, well, if these folks are worried, I should be worried. And so our underwriting standards, everything we do is really focused on trying to mirror the underwrite that the lender's going to put together, so that when they look at what we've decided that we want to do, they're not going to come back with, well, I think you're being a little too aggressive here, or you're actually going to need to spend more than this here. We're not buying your story. So we don't want to skate through that process. And Freddie and Fannie are pretty high bars to get across. Right. We also like the fact that we get some additional exit opportunities with some of the loan product that we're talking about. Right. We don't want to be locked into simply, all right, I've got a 5-year note, and in 5 years, I'm basically gone, right? Because I'm not going to refinance it 5 years and keep it. At least our model doesn't necessarily work that way. But if I've got a longer term note, 10, 12, I think Colonial was a 12-year note, that gives us a couple of different windows that we can play with in terms of what we would like to do, and still leave room for a buyer to come along and put a supplemental on it. And, at the rates that we're talking about acquiring things at today, 5 years from now, I would expect that those would look attractive to a buyer.
Right. So multiple exit options, non-recourse, longer term are some of the things you liked on that piece. Okay, great. And then we're going to go a little further down I-35, down to your third deal, and tell us about this deal, Oakdale. It's 100 units in San Antonio.
So that deal was fully marketed. We tried to do a preemptive offer on it and was rejected. It went to full market. We submitted a offer on that deal with everyone else. Didn't win that offer. Someone else was awarded that deal. And about 30 days later, the broker gave me a call and said, hey, that offer that you didn't win? Are you guys still interested? And we looked at it. They had some new numbers. It was trending in a good direction. We were able to improve upon what our offer was, but it was still less than what the awarded price was. And we worked with the sellers and the broker and got that deal under contract. And we just closed that 2 weeks ago. 2 weeks ago.
Do you know why that first buyer dropped?
I know why we find ourselves in that situation. This isn't the first time that's happened. Okay. We purchased 400 and some odd units a few years back where a very similar situation occurred. We put over $1 million in our clients' pockets because we stopped at our not to exceed number, which our underwrite gives us a not to exceed number, which means $1 more we won't do. I mean, a not to exceed is a not to exceed. And we've had brokers certainly say, I can't believe you're walking away from this deal for X dollars. And it's like, yeah, you're right. It's only X dollars. So drop that and go to my number and we'll be happy to do it. And it's, it's part of that whole, if you're going to implement a strategy about managing risk and providing reasonable returns over long periods of time, you can't get in love with deals. You can't just chase deals. You've got to be disciplined about how you do it. And so we got to the not to exceed number, or near it actually, and said, listen, that's just all we're going to do. When they came back, while they had new data, it really didn't change our not to exceed number. We went a little closer to it and we're able to put the deal together. If you're managing a portfolio, so our fund is a portfolio of assets, we'll end up with probably 5 or 6 properties when we're done with this particular round. If you've got 6 assets and one of them turns out to be a real problem child, well, you're going to have 6 really bad assets then, because you're not going to spend the time you need to on the 5 good assets. You're going to be distracted with the one that's not performing. So better off not to buy a property that isn't really going to be solid and just simply have a smaller portfolio. And Bill's the one that gets to do it. Bill underwrites an awful lot of deals. And there are probably some good deals on the cutting room floor that, would have been just fine for us to take on. Right. But, we say no an awful lot.
Yeah.
We look at 100 deals to get the one that we actually close.
Yeah, I mean, I think a lot of deals are for sale right now, and sometimes the seller, they might have an offer that's 300, 400, 500,000 higher than the second offer, and that buyer might not be qualified though, and they might not have that much hard money, but they're willing to take a flyer for 30 days to see if that guy's for real and if he can get it done. And a lot of times, like either the loan doesn't come in or that guy's equity doesn't show up. And so on a lot of these deals, I mean, I recommend even if your offer is a couple 100,000 lower, still submitting that offer, because 30 days later, you might get that call.
Right. And we have.
You mentioned being able to demonstrate your ability to get it done. So part of that's the track record Bill talked about, right? If we've, so far, knock on wood, everything we've gone under contract on, we've closed. And the good news is we haven't found any reason not to close either.
Right.
But the other is, because we're structured as a fund, we're continually raising capital. So we don't raise capital deal by deal. So we're not sitting here not doing anything and then we find a deal and now we got to go raise $2, $3, $4, $5 million. Money's coming in every week. Well, that money comes and sits in the bank. So when we make an offer, we're able to send along a bank statement showing them we've got $2 million, $3 million, $4 million sitting in the bank. We're ready to go. And in addition to some hard money, that often swings a seller in our direction.
So talk about the fund, because that is definitely a unique characteristic for you guys. And I don't know if you started it before, I guess you started in 2017, the fund, or when did you start the fund? And then sort of what was the target size, and give us some of that and some of the advantages and disadvantages, because majority of the people that we work with are syndicators. And so they don't have any of the equity until they're under contract, and then they do a webinar, and then they raise the money, and then they have 30 to 45 days to raise the money and then put it in the deal. So talk to us about sort of the pros and cons that you found being in the fund model.
So what you just described is exactly what we have done. And that's just the most terrifying thing I can think of, right? Is, to be having to work both sides of the equation at the exact same time. And we did a number of deals like that. And then I sat with Bill in early 2016 and said, there's just got to be a better way to do this. And so we came up with this notion of, well, what if we just continuously raised capital and we fill the hopper up, and when the hopper is getting big enough, we'll go buy something, and then we'll fill it up again, and we'll do that, and so on. So that was the impetus for it. There are so many more benefits that came from the model that we really didn't envision in the beginning. Our investors have the ability to add to their accounts. In an individual syndication, you put your $100,000 in, you're in for $100,000. You can't call them up 6 months later and say, hey, I got another 100 I'd like to put in. I like this deal. There's no place to put it. You get a distribution every quarter. In a regular syndication, you just get a check. You can't do anything with it. In our fund, you can reinvest those, right? So that you get a compounding effect. That adds about 250 basis points to an investor's return simply by electing that reinvestment component over time. And one of the biggest challenges to any real estate investment is liquidity, right? Greater stability than stocks, stability like bonds, equity growth like stocks, if not better, tax advantages neither of them have. But you can buy a share of Apple today, and if you don't like it tomorrow, you can sell your share of Apple. Sure. You can't do that with real estate, except in our fund. So you can buy units in the fund, and then after a certain holding period, if you decide you want to move some of that money out, you can liquidate some of those inside the fund. You can't do that with an individual syndication. And it's quite interesting that you'd think that liquidity component would attract individuals that are looking for more of that flexibility. Our average investor is interested in being in the fund very long term. People are typically talking 8, 10, 12 years or more, which allows us to do one of the other things that the fund is uniquely structured for, and that is to roll up first generation assets into second generation assets. That's our terms. I have no idea if that's what other people describe these as, but the Cleburne asset, it's going to sell, and via 1031, it's going to turn into a second generation asset. And we're going to see higher returns off of that because we're not having to distribute cash to cover the tax burden that's associated with it.
Some additional equity we're going to put into it with it.
Yeah, and we're going to throw some extra equity in that one, so it'll actually be a larger transaction that it rolls up into. But as you do that over time, over an 8-year period, a 10-year period, a 12-year period, you can really see some very significant returns. So by being conservative and focusing long term, while everybody would think that means low returns or very modest returns, it actually really gives you an opportunity to optimize returns over a longer period of time. So the fund is structured. It can run 20 years, actually could be extended a little beyond that. I'll be really surprised if we're here in 30 years, but who knows? We're in a position that we could raise as much as 20 million or more. We're well on a path to be able to do that. It's not so much about how much we raise as it is about getting good fit between our investors and the fund. We spend a lot of time educating folks to make sure they understand what they're getting into and how this is going to work, because an investment like this isn't for everybody. And I can't tell them if it's a good fit or not. And you don't sell this kind of an investment. You educate folks, and then once people understand what they might be getting themselves into, then they can figure out if this is a good fit or not.
One of the downsides that we encountered, so this was our first fund, so we didn't have any experience. We can go back to investors and say, well, here's what the last fund did. So getting investors into the first deal was a big hurdle to get over. That was the hardest part. Once we got that first deal done in Northridge, the second deal, capital raise, went a little bit better. San Antonio deal went even quicker. And we're continuing, we just closed, we're continuing to raise money now at a higher clip than we did getting started. So there's a barrier to entry on something like this that you need to take into account. But now we've got, if we do another fund, we can go say, okay, here's what this last fund did. And a little easier to convince people to trust you
And all
with their
done,
investment.
all done through PPMs and
Yeah, so there's one PPM. If you go to marapolling.com, you can download the information kit, the PPM, the operating agreement, the subscription agreement. One document governs it all, describes how you get in and out and all the rest of it. Bill and I are compensated to do a good job managing all this. And what that means is we get paid at the very, very back end. So individual deals, as they come and go, that's building value for our investors. When the fund closes out at the end, that's when we'll get our payday. We think that really synchronizes the investors' objectives with our intentions.
Yeah, we've been part of deals where sponsors have day one, they're getting 20%.
Right. Sure. Yeah.
And, so all the investors are, losing that right at the beginning. We didn't want to do that to our investors. We wanted to have skin in the game, and they want us to have skin in the game. This way it allows that to happen, and truly our reward is on the back end. We have to perform in order to get that.
So let me maybe take an example for somebody like on the San Antonio deal. How much equity did you need to raise? And then how much was already in the fund that you could show?
So that was about $3 million in cash, I think, was the total number.
Okay.
When we made the offer, I think we were sitting on $2.5 million investable.
Okay.
The reason I say investable is, again, with our secure, stable, modest risk approach, we keep a healthy amount of cash just laying around that never does anything but sit in the bank and help everybody sleep well at night.
Hopefully that's all it does.
Yeah, I hope I never have to use it.
Right. Yeah. Okay. So you can show a bank statement of $2.5 million, and then you go out and you might raise $1 million, but still keep some liquid, and then you
and
can
the rest
close.
of it's still coming in. When you're making an offer on a property, you're 90 days out probably, right, from when you've got to move the money over. Sure. So yeah, it just continues to come in, and the hopper is filling back up for the next deal.
So what are your goals for the rest of 2019?
We're looking to do 4 transactions this year.
Okay.
Including the sale of Northridge, find a replacement property for that. We just closed San Antonio, and ideally we'd like to get 2 more
Sure.
deals in this year.
And then that'll probably wrap up the acquisition phase for this fund. And then the fund will be a little more focused on operations. 2-3 years from now, we'll probably start getting into that sale exchange process. And then we're already beginning discussions on, is it fund 2? Will we maybe do some individual syndications? We do have clients that want to be in individual syndications. So there may be some of that work that we'll do in 2020.
We have a lot of aspiring syndicators and investors who listen to our podcast. Is there if you had like one piece of advice sort of based on what you've learned so far in this industry, what would that one advice be? One piece of advice?
Trust your model. Have a model to begin with.
Have a model. Have a financial model. Yeah.
And trust it. Okay. Stick to it. Like Pat mentioned earlier, we have a not to exceed price. Mm-hmm. You can't fall in love with the property. You got to fall in love with the numbers.
Okay.
And everything's driven by that.
Pat?
So it is just math, and that's true. I would add to that. And that whole notion of, everything you should be doing on a deal, on any of these transactions, should be finding an excuse to walk away. You can't get overly excited about it. What I would suggest, so I'm sure you've got listeners that aren't accredited yet. Maybe they're not ready to write a check and get in on something like this, but they really like real estate. Take the dive. Get a couple of buddies. Go find a duplex somewhere. You're not going to get big returns, but you're going to learn a ton doing it. And there's lots of great material out there. We do a lot of educational work in this space. The more people can learn about commercial real estate and about real estate investing, that's just good for everybody. Everybody ought to have some of this in their portfolio. It simply is another piece of having a well-diversified portfolio. And if you're not ready to participate at the accredited level, then, find another opportunity to get in the game.
And how do people find out more about you guys?
So you can come to our website, marapolling.com. That's MARAPOLING.com. You can always shoot us emails, Pat at Marapolling, Bill at Marapolling. We're not terribly creative on all that, as you can see. We run our own educational series. We have webinars. We have a podcast channel. We've got a bunch of great white papers and so on. You can find all that at the Learning Center at marapolling.com.
We believe that an educated and informed investor is a good investor for our portfolio. And we convince easily as many people to not invest with us as we do to invest with us because we're not a good fit for them. It's either too long of a hold or they're just worried about something or another. And that's why we have this education learning center so that investors can understand what it is they're investing in.
Sounds great, guys. Bill, Pat, thanks for coming along and sharing the story with us. I really have enjoyed catching up and listening a little bit about what you guys have been doing. And for a couple of guys that have been friends and partners for 30 years, that's outstanding to still be able to talk with each other and do what you guys have the passion to do, and that's commercial real estate and specifically multifamily. So, guys, thanks for coming in and spending some time with us. Mr. James Zhang, thank you.
Thank you.
I appreciate it. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.